Hello friends, welcome back to this video. In this video, we will see a very important and an inevitable investment plan, which is the RRSP, Registered Retirement Savings Plan. RRSP offers a way to put up money for retirement and to save on paying taxes today for the amount contributed to the RRSP. An RRSP allows people to defer tax payment on a portion of their income and put it toward their retirement savings. Annual contributions to the plan are tax deductible up to allowable limits, and the income earned in the plan accumulates tax-free as long as it remains there. The key aspects of RRSP is 1. It is an individual retirement savings plan. 2. It is registered with the CRA. 3. It provides tax-efficient savings. That's, annual contributions to the plan are tax deductible. 4. Tax deferred compounded growth of income earned within the plan. 5. It helps build a larger retirement fund. Now, let's see. There are two types of RRSP. The first type is a single vendor plan. Here, all the investments are held in the trust administered by a single financial institution, which is our vendor here. Examples of financial institution includes a bank, credit union, insurance company, or a trust company. The holder of a single vendor plan can choose from a selection of vendors' products like GICs, segregated pooled funds, or mutual funds. But the holders do not make day-to-day investment decisions. Therefore, they have to pay a trustee fee for this type of plan in addition to any management cost incurred for purchasing or for selling the chosen instruments. The second type of RRSP is the self-directed plan. Holders of self-directed plans invest funds in a variety of investments from multiple sources. One biggest advantage here is that they can perform some in-kind contributions, such as certain acceptable assets, securities, directly into the plan. The plans are usually administered for a fee by a Canadian financial services company, but the holders make many of the investment decisions. Although there are rules with respect to allowable content, a full range of securities may be held in these plans. Now let's see what investments into an RRSP are considered qualified and non-qualified. Now let's see the list of investment assets that are qualified investments for RRSPs. They are money on deposit in a bank or similar institution, GICs, government guaranteed bonds and debentures. Here, the term government includes federal government or provincial government. It also includes municipality or a crown corporation. So just for information, what's a crown corporation? It's a wholly government-owned entity established by a legislation to provide essential services as well as manage the national interest. For example, Canada Post, Via Rail, Bank of Canada, CBC, etc. 4. Shares and debt obligations of Canadian public companies. 5. Shares of foreign public corporations and ADRs listed on a prescribed stock exchange. 6. Foreign government bonds with investment grade ratings. 7. A mortgage or interest in a mortgage or a pool of mortgages secured by real property located in Canada. And finally, investment grade gold and silver bullion, coins and bars, and certain certificates based on financial institutions' precious metal holdings. Now, let's see what are the non-qualified assets. Here, the shares and debt obligations of certain private corporations, and then the real estate ones, other than the REITs, which are qualified investments. 3 is commodity and financial future contracts. Finally, properties such as artwork, jewelry, rare manuscripts, and stamps. These are non-qualified investments. Now, let's see when to make contributions. What's the time frame for making the contributions? It's until the first 60 days of the next calendar year. Generally up to March 1st or 2nd of the next year, depending on whether that year is a leap year or not. So now let's see an example. This is 2025 and I have been working as a professor for the past 10 years. My RRSP contribution limit for 2025 is fixed based on my 2024 earned income. So what's this earned income? We'll see in detail about it later. And I can contribute to my RRSP for 2025 within March 2nd, 2026. Because March 1st falls on a Sunday. And I can have them deducted in my income tax return for 2025. Now let's see how much I can contribute each year to my RRSP. There are 3 steps here. The first step is find the lesser of the two amounts. 18% of the contributor's previous year's earned income or the dollar limit set by CRA. For 2025, it's $32,490. And the step 2 is subtract the following. The previous year's pension adjustment and the current year's past service pension adjustment. Finally, the third step is add the taxpayer's unused RRSP contribution room at the end of the immediately preceding taxation year. So, to understand it clearly, let's see an example. In 2024, Maddie's earned income was $60,000 and he had a pension adjustment of $4,400. He had no past service pension adjustment, no unused RRSP contribution room and no previous RRSP over contributions. So find Maddie's maximum tax deductible contribution limit to his RRSP for the 2025 tax year. So, as always, step 1. Find the lesser of the two amounts. One is 18% of his earned income in 2024. That's 18% of $60,000, which equals $10,800. B is 2025 RRSP dollar limit set by CRA is $32,490. Now find the lesser of the two amounts, which is naturally $10,800. Now step 2. Since we have just the PA and don't have any PSPA, just subtract 2024's PA. That's $10,800 minus $4,400, which would give you $6,400. And step 3 is since we have no unused RRSP contribution room, we have nothing to add on. Therefore, his RRSP contribution room is $6,400 that he can contribute up to December 31st, 2025 or within the first 60 days of 2026. That's until March 2nd, 2026. The maximum amount that can be deducted on his 2025 income tax return is $6,400. Now, let's see what is earned income. A general definition would be an individual's net income earned from employment or self-employment. The most common types of earned income are gross Canadian salaries and wages, including bonuses, commissions earned, allocations from employee profit-sharing plans, net business or self-employment income, net rental income from real property, taxable spousal payments received, disability payments received under CPP or QPP, royalties from a published work or invention, and research grants. Finally, supplementary employment insurance benefits, such as top-up payments made by the employer to the employee who is on parental leave. And the following items can be deducted from earned income, which is the spousal support payments paid, employment-related expenses such as professional fees, union dues, or traveling expenses, and finally the rental losses. Now let's see what's not included in the earned income. Any income derived from investments, that's interest income, dividend income, income gained from the capital gains, pension benefits, withdrawals from registered accounts, payments from a deferred profit sharing plan, that's DPSP. All these are not included. The next topic is in which form the contributions can be made. There are two types of contributions. One can be made in cash and the second is in-kind contributions. As we all very well know, a cash contribution to an RRSP is simply putting money from your bank account into your retirement plan. You can deposit funds as a lump sum or regular payments. Now let's see in detail about what's this in-kind contribution to RRSP. When marketable securities are contributed from a non-registered account to an RRSP, they are considered as in-kind contributions, which is a taxable disposition. If the fair market value of the transferred marketable securities is greater than the original cost price, that's the original purchase price, then a capital gain is deemed to be realized, which is taxable at 50% if the total realized capital gains for that year is less than or equal to $250,000. And it's taxed at 66.67% for any gains in excess of $250,000 for any given year. If the fair market value of the transferred marketable securities is lesser than the original cost price, then the capital loss is deemed to be zero. Why? Because the loss is treated as a superficial loss and therefore is denied, because the taxpayer is considered to have disposed of securities at a loss and bought them back immediately thereafter. If a debt security is contributed between the dates on which the interest is paid, the amount of the contribution includes all the interest accrued to the date of transfer. This accrued interest must be included in the contributor's taxable income for the year the contribution is made. Example. Let's see how this in-kind contributions work. It's late February and Leon has not yet made his RRSP contribution. He has no available cash with him now. Therefore, he contributes $10,000 worth of shares from his non-registered investment portfolio before March 1st. The shares have appreciated considerably from when he purchased them for $4,000. So here the capital gain would be $10,000 minus $4,000, which would give you $6,000. What benefits does Leon receive? Immediate tax deduction of $10,000 in kind contribution. Assume his marginal tax rate is 45%. So therefore 45% of $10,000 equals $4,500, which is an immediate savings. And the second benefit is 50% of the capital gain, which is 50% of $6,000 equals $3,000, can be realized the next year. He can claim the taxable capital gain on his tax return for the current year, which is due over 1 year from now. Now let's see the advantages. 1. Tax deferred growth of income. 2. Immediate tax savings. 3. Not affected by job transfer or loss of employment. 4. It provides funds for early retirement. Please remember, the CPP or QPP begin at 60 years and the OAS begins at 65. 5. Creditor protection. Except when the contributions are made in the 12 months prior to bankruptcy, you will be given this creditor protection. 6. Naming of beneficiaries can help reduce probate fees, except in Quebec. And the retirement income splitting using spousal RRSPs, it reduces the effective tax rate on their combined income. And the final advantage is you can access funds for buying a first home or to pay for a full-time training or post-secondary education programs only for oneself or for their spouse. Now let's see the disadvantages of RRSP. When funds are withdrawn from an RRSP before retirement, two things happen. In step 1, a withholding tax amount is withheld by the financial institution and is remitted to CRA and to Revenue Quebec in the province of Quebec. And step 2, in addition, the withdrawn amount is reported as income on one's tax return and additional taxes are paid depending on one's marginal tax rate. So now let's look at this tabular column. When you withdraw an amount up to $5,000, 10% of federal tax is levied on it. For an amount between $5,001 to $15,000, 20% is withheld. If you withdraw an amount more than $15,000, 30% is withheld. And this differs for the province of Quebec. So this step 1 and step 2, it leads to double taxation. So the second disadvantage is the entire value of the withdrawal is fully taxable as income when withdrawn at retirement. Also, no preferential tax treatment for the capital gains, dividend income is given. Therefore, you don't get any dividend tax credit, etc. Another disadvantage is the assets of an RRSP cannot be used as collateral for a loan. Also, if a whole life insurance policy is registered as an RRSP, no policy loans can be taken from the issuing insurance company. Also, the policy cannot be used as collateral. And the final disadvantage is funds within an RRSP are most commonly transferred to a registered retirement income fund RRIF no later than December 31st of the year the plan holder turns 71 years.